The reason why I really like this company is they're not sugarcoating anything here. They're trying to do everything they can because revenues are declining to grow free cash flow and return a majority of that to shareholders. And that's why I really like this company. One of my companies just reported. We're going to go through those earnings. This is a smaller cap company under a $10 billion market cap. Now, if you've been following the channel, this is ideally where I think a lot of value lies in this market. These deep value, smaller to medium sized companies that are buying back stock, that are paying a dividend, that have decent free cash flows are essentially where some of the best values, in my personal opinion, are actually at right now in this market. Now, with that being said, we watched Google sell off here and we watched Amazon recently report earnings and they're down slightly as well, which is now lending possibly some opportunities. I would be looking at Google probably another 5-6% sell-off here, getting between 175 to 180. We're going to run an analysis on Google at some point in time. Would not mind this being one of my top holdings, but let's get into this small cap company that just reported earnings. The name of the company is OpenText, ticker symbol OTEX. Now, this company does pay a 3.5% dividend. The stock has obviously been selling off here, hit a high of $53 and has been trading between 25 to about $30 a share. As you guys can see here, after hours had a nice pop on earnings, so looks like earnings could be a decent story here. Now, this is a company that has AI analytics, cybersecurity for the cloud, and cloud is actually one of the areas why I'm interested. Now, they recently acquired a company but then divested it, so it's been a turnaround story for this company, and that's why we've seen the price completely collapse from over $50 a share down to where we are today, around 25 to about $30 a share. Having it sit in value territory around 8 times forward earnings, and this is where I started accumulating. When I ran my analysis, I said anywhere between 25 to about $26 a share would make sense to start accumulating in this company, even after they divested from AMC. Now, at first glance, we can see here that total revenues decreased 13.1% and annual reoccurring revenues decreased 8.1%. So right off the bat, you're thinking, okay, well, there's not much here. This is why the stock is selling off from $53 down to $25. But then we take a look at cloud revenue actually increasing by 2.7% to $462 million that they did in the quarter. Then we take a look at some other things that are taking place here. Net income margins rose to 17%. Adjusted EBITDA margins are now sitting at 37.6%. GAAP EPS was 87 cents. Non-GAAP EPS was sitting at $1.11. Operating free cash flow was sitting at $307. So we have a company here doing $1.3 billion in top line revenue and free cash flowing $307 million down to the bottom line while they're growing cloud revenue and while they're growing margins. In the quarter, they returned $134 million of capital to shareholders, $68 million coming from dividends, and $66 million coming from share repurchases. So the thing I wanted to point out is while revenues were declining, we did see free cash flow strengthen here, and we also saw earnings per share strengthening as well. So what makes me hopeful that we are seeing a bottom in the stock is the fact that they did have record enterprise cloud bookings of $250 million. They're increasing 2025 free cash flow target range, and they're increasing shareholder return of $570 million plus dollars. We can see a list of 2025 customers that they did acquire, and they're not giving us any crazy ideas of what they're going to do here. We can see here that cloud growth is going to be between 2 to 5%, and they're projecting out between 1.85 to 1.9 contributed to cloud revenue. Annual reoccurring revenue coming out to about $4.2 billion, with total revenue coming in about $5.2 billion. From the last earnings and why the stock has sold off from $53 to $25 is because of what their guidance was. And we can see here that they are guiding for less revenue, but they are guiding for a little bit more free cash flow here. They're returning 50% of free cash flow to their investors by dividends and buybacks, as they stated in this promotional piece, and about 14 to 16% of revenue is going to go into research and development. They're hyper focused on the future, and I think we're going to see revenue stabilize from here on in and probably see growth going into 2026. So with 2026 guidance in the books here, we can see that their aspirations for 2027 is total organic revenue growth between 2 and 4%, and total revenue growth starting to push that $6 billion mark, with EBITDA margins sitting between 36 to 38% and free cash flow sitting about $1.2 to $1.3 billion. I believe it's priced right, and I believe that they have a strategic turnaround that's taking place this year going into 2026, and that's why I started buying some shares around $26. Now, the stock's starting to push over $30. We'll see if it holds, but if it dips below 25, I definitely would be adding more into my position personally. This is not a recommendation to buy or sell stocks. This is just personally what I'm doing. So I have the numbers pretty much identical to what they're telling us. They said they're going to do between 600 to 650 of free cash flow. I have them doing $636 million of free cash flow on $5.3 billion. And if they can execute to 2027, as you guys can see here, I have them doing $5.5 billion, but they're projecting out as high as $5.9 billion. So we're building a lot of safety here, saying that they're only going to grow about 2% across the board. I think all these are realistic expectations. This company has nice free cash flow margins, which is going to allow them to really invest in research and development, maybe do some mergers and acquisitions, pay out dividends to shareholders, possibly grow those dividends and make buybacks, which is going to be accretive to earnings, right? So when I look at this company, a lot of opportunity here, very, very cheap company, reasonably priced, a little under an $8 billion market cap. If we think about 2027, they were projecting out nearly $1 billion to $1.2 billion of free cash flow, which means we're basically looking at a company that's trading between maybe 5 to 7 times free cash flow, which is extremely cheap in this market. For right now, I have a 10% required rate of return. We have to factor in that there is a 3.5% dividend yield that looks very safe with this company because of those free cash flows. So what I'm going to do is actually knock this down to about an 8% rate of return. If we factor in the 3.3% dividend, or we factor in that 3.5% dividend, we're looking at an 11.5% rate of return on a company that could actually surprise to the upside. We're building a lot of safety here. So I think if we get an 11% rate of return with the upside ability here, very, very safe and consistent compounder here with buybacks and dividend payouts. We take a look at this. Ideal stock price is sitting at $26.50. This is why I've been accumulating around $26.50. Now let's bump this down to an 8% rate of return, because if they are right about 2027, well, we're going to get paid in 2027 and beyond, because we're really having an opportunity to accumulate at pretty depressed prices here. Our ideal stock price actually comes in between $31 to about $35 from a free cash flow standpoint. So you guys can see here that this is a pretty interesting setup. I think the bottom is very, very close around that $25 range. So accumulating at 26, I'm very happy with. I like the direction of the company. I like the fact that they're very transparent for a small cap company. Now, the big opportunity is going to be multiple expansion. Now that investors' confidence is growing, they're projecting out that they can grow revenue in 2027 and beyond, that they can grow free cash flows in 2027 and beyond. You're going to see multiple expansion. What does that mean? We're using an 11 multiple to enterprise value to EBITDA. When we take a look at what pairs are trading for, we can see here they're trading at 16 to 20 times a multiple. Now, I don't think they're going to get that type of multiple, but maybe they get a 12 or 13 multiple. And so let's say that they do get some multiple expansion here and they get a 13 multiple on their enterprise value to EBITDA. Well, we can see here, we could be looking at close to $100 stock with the buybacks that they're going to do and with the growth that they could achieve. So you guys can see here that there is a lot of upside here if this company can execute, and I don't think there's a tremendous amount of downside. To be quite honest with you, I think a high probability is this company getting acquired soon, because somebody can acquire this company possibly for, call it $10 to $12 billion, and know that in 2027 that they could be getting more than $1.2 billion of free cash flow, not including the synergies it has with the company, which means that you're looking at a 10% free cash flow yield on this purchase. Very, very interesting overall, in my opinion. So as always, guys, wanted to break this one down for you. Hopefully you guys enjoyed. This is one of my smaller cap holdings in the portfolio.